Good afternoon, agents. I'm getting a lot of calls from a lot of you asking me what's going on in the market right now because a lot of you saw the news over the weekend about Silicon Valley Bank getting taken over by the feds. There was another one yesterday that got taken over, and there is a third one probably falling today. So I know that you guys want to know what's going on. So this one's going to be a little bit longer of an update, but we want to make sure that we're giving you the information. It will be a little bit technical. I will be putting another one out there on my personal page and for Rebecca Foot Mortgage Team's regular YouTube channel that is not quite as in depth. But your agents, I know you understand more of this than the general public, so I wanted to give you a little bit more background. So I'm going to go ahead and share my screen right now. Let's do this. Okay, so first thing you got to do is you got to get the backstory so you understand what's going on. So in 2020, 2021, we saw mortgage rates in the 2s and 3s. You know this, that's not a surprise. And during that time, we also had the COVID bailouts happen, right? We had the COVID stimulus packages, the government was printing money. And I told you back then, bailouts come at a cost. If you recall that, bailouts come at a cost. And the bailouts come with inflation. That money has to be paid back somehow, and that came with inflation. So in 2021 into 2022, we saw that inflation. And when that was happening, the Fed kept saying, oh, inflation is transitory. Don't worry about it. It's no big deal. And we kept saying it's not because of all these bailouts. You can't spend money and not have to pay for it. And then in June last year, we saw inflation hit 9.2%. That was the highest it hit last year. And then that's when the Fed finally started to act. They finally started to raise the federal funds rate to help lower inflation. As inflation goes up, the federal funds rate needs to be raised in order to bring inflation back down. So this was something that we wanted to have happen. But the problem was our Fed, they can overcorrect. And we've been saying this and how we're concerned about them overcorrecting. Do you realize in 4.5 months, the Fed has raised the federal funds rate 30 basis points? That's 3%. They have raised it. In 7.5 months, they raised it 3.75%. And our federal funds rate now is at 450 basis points, so 4.5%. So continuing on with the backstory, in January of this year, we saw mortgage rates fall. They went down, February 2nd, rates were touching in the low to mid sixes. So this was great. You saw the market pick back up. People were writing offers, locking in at these lower rates. And this was a good thing. Now, February 3rd, our world changed when the job report came out. And that's because we were expecting 188,000 new jobs, but we got 570. 570. Now, this was a big deal. This blew open the doors because investors were now expecting the Fed to raise the federal funds much higher in 2023. So the jobs report ended up not being totally accurate the way that it was presented on the news. That's a whole nother topic, but it definitely concerned investors that we needed to raise the federal funds more. Now, last week, General Powell, he's our Fed chair, he came out saying that the Fed was likely going to raise the federal funds rate 50 basis points at the next meeting, which is March 22nd. So he's already telling the markets this is coming. Now, you have to understand when somebody opens their mouth like this, it's on the one hand, it's good because it's not going to shock the market when they actually do the raise on February 22nd. But it still affects us and it affects the markets. So when this happened in the short term, now this is not the right equation. In the short term, as the Fed raises the rates, you're going to see mortgage rates go up. Now, in the long term, that's not the case. But when they did this last week, you saw mortgage rates hit 7% again. So we had that dip down in January, beginning of February, and then boom, it went back up. Now, investors are saying you're going to have to raise the federal funds rate. You're going to have to take it back up all the way up to 5.75, maybe even 6%. So we're on a roller coaster, folks, and it's going to continue and it's going to get worse before it gets better. So I want you to take a step back here and understand interest rate risk. Now, I'm going to tell you, we were showing Grayson, my 9-year-old son, this over the weekend and explaining to him all about loans and collateral. And, he's my child, right? So he's going to learn this stuff. But this is a great example for you. And if you've taken my boot camp, you understand this because this is the exact same thing we show in boot camp. So Rebecca, I lend Grayson, my son, $100,000 at 3% interest. Okay. If I do that, how much interest is Grayson going to pay me over the course of a year? So 3% of $100,000 is $3,000. So he's going to pay me $3,000. Now, here's the problem. Maybe I lent that to Grayson 2 years ago when rates were at 3%, but now rates are higher than that, right? I can now lend that money out at a higher rate. So what if rates the next year after this, they go to 6%? Is my loan to Grayson still worth $100,000? And how much would I have to invest in a 6% market to yield the same $3,000? So I'm giving you all these answers. Don't worry. I know it's complicated. $50,000 is the answer. You would have to invest $50,000 at 6% to yield that $3,000 versus $100,000 at 3%. Did I say that right? $50,000 at 6%, $3,000. $100,000 at 3% is $3,000. So I have to basically invest double my money to get the same return on investment. All right. Does that sound like a good option? No, right? I want to take my money back from Grayson at 3% and go over here and lend it at 6% because that makes more sense to me. Now, is the loan that I lent Grayson still worth $100,000? If I was going to sell it to you today, would you pay me $100,000 to have that 3% loan? Or are you going to take that and sell it, take your money and invest it somewhere else? You're going to take your money and invest it somewhere else, somewhere you could earn that higher rate of return. So my $100,000 loan is not worth $100,000 anymore. It's worth closer to $50,000 because of the interest rate risk. Now, imagine a bank that has $100 billion in investments. That's scary, isn't it? And this is the problem that you're going to see as I show you this. So the banking system, let's explain how this works. Let's say they have $100,000 in deposits. Obviously, they have more than that, but we're going to use round numbers for examples. Bank gets $100,000 in deposit. Now, the bank is required to hold reserves on their money, on their deposits. Now, the exact percentage varies, so don't get too concerned with that. But let's say it's 10%. So they're going to hold $10,000 in reserves, and they want to loan out the other $90,000 because they want to make money on it, right? So they're going to lend it out into safe term investments, things like business loans, car loans, home equity lines of credit, that kind of stuff that's going to be a safe investment for them. Now, they can also invest in things like mortgage-backed securities and treasury bonds. So let's look at an example here of a bank that invested, let's say, they bought mortgage-backed securities. The mortgage rate was at 3%. So this is like what happened a couple years ago. And if you take my boot camp, you know that just because the borrower paid 3% on that mortgage, the mortgage is not worth 3%. It was probably worth more like 2%. So they call it a 2% coupon. So the banker is not getting 3%, they're getting 2%. Now today, the 2% coupon investment is worth significantly less because mortgages are higher than 3%, right? So it goes right back to that example of me lending Grayson money. People aren't going to want those mortgage-backed securities. Now, you may have heard the term mark to market, and that's where banks and investment banks and all that kind of stuff, they are required to change the assets on their books, mark to market it. So they have to bring it to what the current value is. So just like that example of me lending Grayson $100,000, I would have to change my books to show that that investment now is only at $50,000. Okay. So think about that. Now, instead of having $100,000 in deposit, I basically have just lowered my investments. So my reserves have to increase to keep within that 10% tolerance. So it ends up causing a problem. However, with the banking systems and the 2008 Dodd-Frank Act, banks are no longer required to mark to market all their investments. If it's an investment that they're going to hold to maturity, they are not required to actually show that loss on their balance sheets. So you don't see that negative show up. All right. So on paper, it's not there. That loan is still worth $100,000. Now, here's the results of these reckless actions of the Fed. People want more money for their investments, right? Why do I want to leave my loan with Graystamp 3% if I can go over here and do it for 6%? It's the same thing. People want more money. You're not going to leave your money in a savings account earning 1% if you can go invest it in a treasury and make 4%. That's what you're going to end up doing. So they want higher yields that are safe, like a 5% short-term treasury would be an example. And the money begins to be drained from the banks because people are taking their money out of the bank and they're putting it into other investments that are yielding that higher rate of return. But remember, banks only have a fraction of that deposit money available, right? Because they already lent it out. So they only have, let's say, 10% available of all their deposits because they lent the rest out. Now, let's look at Silicon Valley Bank. So their balance sheet showed that they had $12 billion in assets. And under the held to maturity calculation that they're allowed to do, they don't have to account for $15 billion in losses because they're not required to mark to market. If they were required to mark to market, you would go from that $12 billion in assets to negative $3 billion. So big difference. Now, February 8th, Jim Cramer from CNBC's Mad Money show, he came on telling people that SVB's stock was still cheap. There's room to run on this stock. I mean, it's going to get better. And this shined a light on SVB. And savvy investors took notice to what was going on in the bank. And they started doing some digging. And they realized this hidden $15 billion of unrealized losses. Remember, they're not required to show those losses, but they realized it. And when they did, the investors began shorting the stock. And this drew more attention to it. And when they shorted the stock, one person saying, hey, you might want to go get your money out of SVB if you have money there. And they told somebody else, and they told somebody else. And all of a sudden, there's a run on the bank. Everybody's trying to pull out their deposits. But remember, they only had 10% of the deposits, right? So what happened was they were forced to sell $21 billion in assets to realize a $2 billion loss. That's just crazy. And investors are now noticing the remaining $13 billion of unrealized losses, and they only had $60 billion in securities. And basically, the bank becomes insolvent. Now, as we said, it caused a run on the bank. They cannot meet the demand, and the crisis began, right? This has huge impacts because deposit monies are insured up to $250,000. But that's it. After $250,000, you lose your money. This was a big tech bank. You had people like SEOs at tech companies that $10 million in their accounts there. You had companies like Roku that had $500 million there. And all that money's gone because 93% of money in SVB was outside the FDIC insurance limits. So to those companies and those people, their money was gone. And that's why there was such a run on the bank. Now, other banks became under scrutiny because of all this, right? And the problems began to spiral. This all happened in the last week, okay? That really got really bad. So on Sunday, Janet Yellen, she's our Treasury Secretary, she came out on Friday saying the bank sector is resilient. On Sunday, she said there will be no bailout. No bailout, right? An hour later, the Fed stepped in. The Fed and the FDIC came out saying they are going to protect investors. This is a good thing. We need this to happen because you can't have this kind of magnitude of people losing that kind of money. So they've stepped in and they are protecting all the investors' deposits. And they are doing this by doing a bank term funding program. And this is something new that allows banks to trade in their underwater securities into the Fed. So that 10-year treasury that they bought at 1 or 2% interest, that's now worth 4.5% interest because it's so much higher yields right now, they can turn in that 2% one and get money at face value for it. So if it was a $100,000 treasury, they can turn it in at $100,000 instead of the lower discounted rate that they should be getting for it. All right, call it whatever you want. It's a quasi bailout because that's exactly what happened. They stepped in and bailed them out. You saw another bank go down yesterday. There's a third one probably going down today if it hasn't already, because I haven't been all over the news. But it's happening. You're going to see more of this. Now, here's the important part. What does this mean for us, right? So first, it's a flight to safety. Now, this is not good for the stock market, and over time, you're going to see it's not good, but it is good for depositors, and it leads to more uncertainty in our market, though. And our Fed needs to rethink their reckless policies, because by increasing the rates as quickly as they did, as fast as they did, as much as they did, it's caused issues. And now you got other central banks, like the European Central Bank, they're rethinking their policies as well. And because this also brings importance to the noticing of the negative yield curve, which is something I had talked about, or I should say inverted yield curve. This is something I've talked about in other updates, how you can invest your money in a 1-month treasury and earn more on it than a 10-year treasury. Typically, you earn more the longer you invest it for. Right now, you can invest it in a much shorter term treasury and earn more than the 10-year treasury. So that's something to think about. Is this just another version of quantitative easing, which is something that faded out last year? And then it's also deflationary. So it will help bring down inflation right now, which is going to bring down mortgage rates. So the big thing is the Fed doesn't understand the lag effects that happen when it comes to economic reports, such as the jobs report or the consumer price index reports. And this is the same thing. It's the same thing as having a patient and you're given a medicine and, 5 minutes later, they're not better. So let's give them more medicine. 5 minutes later, they're not better. Let's give them more medicine. And before you know it, you overdose the patient. And that's exactly what happened here. The Fed overdosed our economy. And, you got to do small adjustments, not big adjustments as quickly and as fast as they did. And that's the results. The good thing is for 2023, you are going to see a lot of, you're going to see, it's going to really help our market. Okay. You're going to see rates come down. So you're going to see people that are able to actually buy houses now. You're probably going to see a lot more bidding wars because of this, but this is going to make 2023 even better than what we were expecting it to be at the beginning. So there's one other thing I want to show you real quick is here. Let me just show you the bond charts today, because this is where you see, this is, look, February 2nd. See that right here in the chart? It's February 2nd. See this big line? It just came all the way down. That was us rates going up. But now, sorry, I knew that was going to happen. But now you see these two. This is today where we're seeing rates getting better. And we are now testing this black line right here. That is the 50-day moving average of interest rates. So we are testing that. So that's good. And rates are doing better. So expect 2023 to be a much better year than you were expecting to begin with. You're going to see rates come down because the Fed doesn't have a choice right now. They're going to have to lower the federal funds rate. So on the March 22nd meeting that we were expecting a 1/4 point increase, then Jerome Powell came out saying it's going to be more like a 50 basis point increase. Now Goldman Sachs is saying they're not even going to increase it. It's just going to remain flat. And they're even predicting through the end of the year, they're going to actually be lowering it. So stay tuned. We'll try to keep you updated as much as we can. But I know that was a long report today, but I wanted you to get the backstory. If you have any questions, don't hesitate to reach out to us. If you do have a client that is locked in with us, we already called everybody this morning and we told them we are working with them on rates because you haven't quite seen the decreases in rates yet, but it's going to be a roller coaster of a ride and you will see them coming forward. So all of our clients have already been called. I hope you all have a great rest of your day.